Morning, everybody. My name is Scott Phillips. I will be presenting today a disclaimer that out there that this isn't considered to be advice, but please reach out and contact us with any questions you have. Again, my name is Scott Phillips. I'm an audit partner with Eide Bailey. I'm going to be presenting today with Matt Nair, who's an audit manager with us, and then also Andrew Mao, who's one of our tax specialists. So as we go through this today, I'm going to kind of skip this first slide here, but as we go through it today, we're going to spend the first 40 to 45 minutes talking about the GAAP reporting and lay a foundation of the new accounting pronouncement and its implications. In that much time, obviously we can't get into a deep level of detail, but that said, hopefully we get into enough detail that it gives you an overview, but also gives you enough to get started. Hit a few points on some practical considerations of how this standard works. We'll go through some journal entries. We'll get to at least to that level of detail, so you'll see kind of what the impact is when we start to sketch this out and put it on a balance sheet, what it looks like in the financial statements. And then in the last 15 to 20 minutes, Andrea will talk about some tax considerations. So as we get started here, what I want to do is this first slide talks about current accounting guidance, which I presume many of the people on the forum are familiar with, but I do want to just briefly touch on this because we're going to build on how it changes from here. In our current guidance, and one more thing is we're going to focus primarily on the lessee accounting. There is some lessor implications, and we'll touch on that a little bit, but it's primarily from the lessee perspective. So in our current guidance, we have for lessees capital leases and operating leases. And operating leases, of course, are not on the financial statements now. There's a payout disclosure where we talk about what the future payment obligations are, those commitments. So those are a disclosure, but not actually on the face of the financials. And then if you end up with a capital lease, and you can see in the bottom of the slide the criteria for a capital lease, then it ends up on your financial statements as basically a financing of building equipment, property equipment, whatever it is. And these tests here in this capital lease section are bright line tests. If ownership transfers, if there's a bargain purchase option, or 75% of the useful life, or the 90%, those are bright line tests. And it's important to know that as we get into a slide later on and we talk about the shift in accounting treatment, we're going to build on how it differs from the current guidance. So as I go through this standard, you know, a lot of people think, well, if it seems to be working now, if it's not broke, why did they change this? And there's been some discussion about the difference between a capital lease and operating lease, and sometimes it's a fine line or as to when or not an operating lease ends up becoming a capital lease, if it's close to that 75%, if it's 74%, or if it's maybe it's not 90% of the useful life, but it's 88%, and people are close, and so sometimes it ends up on the balance sheet and sometimes it doesn't when they get close to those bright lines. So that was causing some diversity and you know, maybe some aggressive accounting practices. So that was one thing that's been regularly brought to the FASB's attention. The other thing is that the FASB has kind of gone down a path along with the international standards to say, well, let's put everything on the balance sheet. If we get it all on the balance sheet, people tend to pay closer attention to the balance sheet than the disclosures. And while the disclosures are important and imperative, at the same time, the FASB felt like if it's on the face, if people don't want something on the face of the financial statements, they can easily subtract it to come up with some numbers that's relevant for them, but it's more difficult if they don't have that information to then add it to it. And a lot of banks will take that information, those disclosures, and they'll do some sort of formula or analysis based on those operating lease payments. So they felt it was relevant to put them on the face of the financial statements in the form of a right to use asset. Again, we'll get in the details of what that means, but one thing that's unprecedented is that this guidance for leases is actually for any public entity. It's effective for this year, fiscal year 19. And then it was supposed to be effective for non-public entities in 2020, so next year. But just a couple of weeks ago, the FASB released an exposure draft proposing to delay the effective date 1 year for non-public entities. So, and by non-public entities, a lot of times we think of a public entity being an SEC filer, but that also scopes in any conduit debt obligors, anybody that's got bonds, which primarily happens in the nonprofit arena where there's a bond, which bond is publicly sold, so there's a public interest, and so they get scoped into this. Occasionally, the for-profit arena will also see industrial revenue bonds. So anybody with those types of instruments, they still have the current effective date of this year, 2019. But anyone else, there's a potential, or it's likely, I would say, that it's going to get delayed 1 year, so it'll be 2021 instead of 2020. The comment period ends here in about 2 weeks. I imagine that pretty quickly after that, I don't think it'll be opposed. And if anybody's interested, if they've already kind of gone down that path, or they've gone far enough down that they want to implement, as you can see on the bottom of the slide, early application would still be allowed, so it wouldn't prohibit anybody from adopting anytime from now on. And so I doubt that that exposure draft will be met with much opposition. In the transition year, there's two methods for adopting, or two allowances. One is to recognize in that first point the earliest period presented, meaning if you have comparative financial statements, then you'd go back and determine what the effect of the adoption of the lease standard is, and you would apply it to both the periods presented. The other option is you are allowed to only recognize it in the year of adoption. So if you have a comparative financial statement, and let's say you decide to adopt in 2021, you would not have to adopt it for the 2020 year. It would just be the year you adopt in 2021. But if you choose to do so, all the previous disclosures for your 2020 year in this example, where you did not adopt, you'd have to retain all those disclosures, even the payout schedules. All those would have to be retained. So you'd actually have a set of disclosures that support the prior year that's being presented, where the adoption didn't take place, and then the new disclosures for the current year. So something to take into consideration. So let's get into the standard a little bit. First thing I want to point out in this top piece is that it's for all leases over 12 months. The FASB did provide a carve out for short-term leases. Normally this happens, we see it a lot in the construction industries, but can happen under other industries where somebody might rent a piece of equipment, a backhoe, a forklift, or whatever it is, for a period of 4 months, 6 months, 3 months, 9 months, whatever it is. They'll just have these short-term equipment leases for specific projects or particular tasks. Those are allowed to be excluded. The FASB does believe that the income statement impact will be very similar to the current guidance. And again, when we get into some journal entries and kind of show the different accounting, while it does have a significant balance sheet impact, they believe that it will have a relatively similar impact to your income statement. The lease classifications, they changed some terminology, and we'll talk about that, but the classifications of capital versus operating are very similar. And then because these leases are going to end up in your balance sheet, the real question is it a lease or not? So that becomes a more important question, and I'll go through an example of that here in an upcoming slide. Another key point of the lease is determining lease components and non-lease components. For example, if you have a lease for a building or some real estate, and with that comes you have to pay for maintenance on the building, those types of things, insurance. If you're required to cover those pieces, those would be considered a non-lease component. They're not part of the right to use, and they would be a period cost versus some long-term obligation or liability. The standard does allow that if you can't break it out or choose not to break it out, you could just include it as part of the lease. Obviously, that would result in a larger lease liability. But that'll be something to think about and potentially go back as you're looking through your leases and determine if there's non-lease components, if they're really available in the lease documents, or if they're not, do you need to go back to the lessor and start to gather that information and ask them for a breakout of how much of that lease might be for non-lease components. If you have to pay for the maintenance separately, then it's obvious, but if it's part of the lease contract, but there's a maintenance component, we see that a lot with copier leases. We'll have organizations that rent or enter into a lease agreement, and they'll have 20 copiers, and so it becomes a material component, but they have maintenance built into it. It's all just one payment to them, but there's a maintenance component to it that could potentially be split out and become a period cost. In the middle of this slide, this is a significant change from current guidance also, is that currently when we think of related party leases, particularly we see these in the real estate side of things, but where there's a common ownership entity that owns the building or facility. A lot of times right now we think of this as substance over form, but now under the new guidance, is this legally enforceable? Is there, either directly or indirectly? Perhaps it's maybe there's no legally enforceability in the contract the way it's written. It could be month to month. Either side could cancel at any time. But if there was a loan or debt on that facility, and within that debt, it required there to be an obligation between the two entities or a commitment on that lease that it couldn't be broken, without the bank allowing it or something like that or being involved, then perhaps there is some legal enforceability, indirectly in there. But that'll be something to look at is in those related party leases. I know a lot of organizations are looking at restructuring their related party leases to go month to month to keep them from going onto the balance sheet. And that'll be something to look at is there some either direct or indirect legal enforceability. But again, it's not a substance over form situation anymore. It really is legally enforceable. It's kind of the new term in terms of evaluating those related party leases. So then when we get to the definition of a lease, I mentioned earlier in an earlier slide that now the question isn't necessarily operating versus capital as much as it is, what is the definition of lease and do you have a lease or not? So a lease is a right to control the use of a specifically identified asset. As you look in these bullet points, we talk about on one, on the left side, identified asset, and on the right-hand side, control or use of that asset. On the identified asset, if you look at the bottom point, the supplier does not have a substantive substitution right. So let's talk about what that means. If you have if you enter into a lease for a series of copiers, and if one of them breaks down, the lessor has the right to come in and just replace that, then is that a substantive substitution right? In that example, the answer would be no, and this would still be considered to be a lease, at least in terms of identified asset and control over that asset over a period of time. What they're really talking about there, and we see this probably more in transportation contracts, is let's say that you enter into a contract for transportation with a trucking company. Do you have a lease with that trucking company or not? Well, an example where you would not have a lease with the trucking company is if the trucking company, they manage, the driver is their driver, they determine what the route's going to be. If they decide that, hey, we can transfer this quicker on a railroad, so we substantially decide that instead of trucking it, we're going to put it on a railroad and railroad it and use rail car to transport it. So in that case, there isn't really a specified asset. You don't have control over that asset, being the driver, potentially a change in mode of transportation. So that would be an example of where you don't have where the supplier has a substantive substitution right that potentially would disqualify this from being a lease. So something to turn around and evaluate. But I think most of the time the leases are pretty clear, and really so the real question is coming into this next slide, is it an operating lease or a financing lease? So from here on out, we'll start referring to capital leases as financing leases. And in this next slide, we go through what the difference between an operating lease and a finance lease is. The criteria here, as you look them over, are very similar to the current capital lease guidance. If you transfer ownership or have a bargain purchase, or the first two. The next two, number 3 and 4, are very similar to the current capital lease guidance, but a little bit different. They're more principles based. So number 3 says, do we use it for the remaining economic life, or a major part of the remaining economic life? Right now, there's a bright line test that says 75%. If we use it for 75%, that is a capital lease. Under this guidance, 75% is still used as a rule of thumb. In fact, it even talks about it in the guidance, but it's not a hard and fast rule. So if you did the math and it came out to be 70%, you might still consider that to be a financing lease, formerly known as a capital lease. So there's a little bit of flexibility there. For number 4, the current guidance also says the rule of thumb would be 90% for the present value. But what if you come up with 88%? Would that still be considered a financing lease? Under the new guidance, principles-based approach, it could be. I've had worked with several clients who we would go through the evaluation. We would look at the different assumptions, the discount rate. Do we think the discount rate is appropriate? And when we did the math, if it came out to 89.4%, we said it was operating. And if it came out to 89.5%, then we debated whether or not to round it up, and it became a capital lease. Under the new guidance, if it's approximately in the 90% range as a rule of thumb, and again, so it could be less, then you could still end up in a financing lease arrangement. So that's something that's a little bit of a twist from what we're used to, is taking away that bright line test and making a principles-based approach and saying, well, how close is close enough? So that'll take a little bit more judgment on a go-forward basis. The last item is new, and it is that if the asset is very specific with no alternative use. I see this a lot when people have either a very specialized piece of equipment. Sometimes there's a specialized piece of storage equipment. Sometimes there could be a facility that's constructed in such a manner that's very unique and customized in such a way that if the lease term were to end, there would be really no alternative use for that lessor to turn around and sell off that piece of equipment or that facility. So if there's really kind of a unique and customized piece of equipment or a facility or something like that, and there's no alternative use, then that's considered to be a financing lease. So again, a change it from current guidance. If it meets the criteria to be a financing lease, then we would record it, again, similar to our capital lease. And if it doesn't meet one of those criteria that we just talked about in the previous slide, then it becomes an operating lease, again, similar to current guidance. There's also a couple criteria here that if substantially you're buying the asset, if you do the present value, and there's a residual guarantee for the value, and it's probable that you collect it, it could be from a lessor's perspective, that might be considered a direct financing lease. Again, focus of this is really on the lessee accounting, but that potentially would be a lessor implication as you're doing your evaluation if you're in a lessor situation. So with that, I'm going to turn it over to Matt, and he's going to walk us through kind of some more detail about evaluating lease terms and what the accounting looks like when we start to record this with debits and credits.
Sounds great. Thanks, Scott. Like Scott said at the introduction, my name is Matt Neer. I'm a senior manager in the National Insurance Office with Eide Bailey. And I'm going to go through a few more of the kind of technical terms within the lease. All right. The first thing we're going to talk about here is the lease term. And I guess maybe judgmental here, but I think this is one of the most significant areas of the new standard and changes, and the area that there's going to be a significant amount of judgment and when you're valuing as far as recognition and then also measurement of the lease. Really those two parts, when you figure out what the lease term is, you can see if it's going to qualify for that 12-month exemption under that short-term lease, and so then it would not have to go on the balance sheet. And then also the kind of the second piece that's really important here is obviously the longer the lease term, the more lease payments are going to be included in valuing and measuring that initial liability and that liability going forward. So determining the lease term is a very important part of this new standard. And how this is done is there's the kind of the obvious piece is the non-cancelable period within a lease. So let's say you have a lease that has a 5-year term and then it has a 5-year renewal option. That initial 5-year term, that's the non-cancelable portion of that lease. That's the obvious part to include. But now there's that 5-year renewal option that's within that. And should we include that or not? And really that part comes down to a term called reasonably certain within the standard. Are we reasonably certain to extend that lease? Are we reasonably certain not to terminate that lease for that period? And then also there's, if that renewal portion is controlled by the lessor to extend or to terminate that lease, then that has to be included. So there's a lot of factors that go into this reasonably certain. We're going to talk about that in a second. I want to go back to maybe something that Scott had touched on a little bit earlier related to month-to-month leases. I think there's maybe a common misconception out there that, hey, if I have a month-to-month lease, that automatically gets me to the short term. It's under 12 months. I don't have to put it on the balance sheet. And that's not always the case. And I think Scott kind of reiterated that point, but you really need to assess what the lease term is in that 12 month, because if that automatically renews and it's automatically renewed for several years, your lease term is really longer than 12 months. It's longer than that month-to-month agreement. And so you could have to put that lease on the balance sheet. And in that related party realm, a little bit, there is legally enforceable rights that Scott touched on, but also with that, there's a part of the standard that says that if either party can terminate the lease without permission from the other party with no more than an insignificant penalty, then there is no more legally enforceable right within that contract. So something to take note of, but also within that, as Scott mentioned, you should look see if there's any kind of debt obligations that make certain that that lease stays in place. So some factors to consider when you're looking at the lease term. Just some more considerations, kind of diving more into this reasonably certain concept. The standard really lays out relevant factors, relevant economic factors. There's really 4 buckets that they put in: contract-based factors, asset-based factors, market-based factors, entity-based factors. And really, they're not saying that these are any kind of bright line tests. They're just considerations that you need to make when you're assessing this reasonably certain to exercise or terminate a lease. And things to consider within that, you could have an asset-based factor related to leasehold improvements. So if you have an office space you're leased, you've invested a significant amount of money into leasehold improvements. That could extend the lease term to a more significant period, and so you'd want to include possibly the lease term through, you know, the economic life of those leasehold improvements. Other things to consider, you know, contract-based factors: is there cost to terminate the lease? Is there maybe penalties that are within the lease that the lessor could collect if you terminate it early? Also, you know, market-based factors: is the rates, the lease rates, the lease payment within the contract, is that based on a market? You know, is it continued into the future? Are payments going up within the market, and so you potentially would be in that lease for a longer term? Something to consider. Also, some maybe strategic things, such as, is this say it's a manufacturing facility that's instrumental to your operations, and so you're more likely to be in that facility for a longer period of time. And so that could be a factor in exercising some of these options to renew. Another piece, kind of going down to the lower left box, reassessment of this lease term. It is possible that you could reassess this lease term after the commencement, and those are really for factors that are under the control of the lessee. So things that are under the lessee's control, business decisions, like I said, with leasehold improvements. Now, let's say, you know, a few years into the contract, now you've made some significant leasehold improvements. That could be a time when you would reassess the lease term of the contract. Or if maybe there's an exercise option that at commencement you weren't reasonably certain to exercise, but now you've actually exercised that option, that would be a factor that's within the entity's control. That reassessment would need to take place. Factors that are really outside the entity's control, market rates. Let's say lease rates are significantly increasing or decreasing. At commencement, that could weigh into your decision as reasonably certain, but after that period, after that lease has already started, you can't reassess just based on kind of those market factors that are out there. There would have to be another reason for you to reassess the lease before you would take into account that market rate factor. And then the last thing on here in the lower right there, the short-term lease, we hit on this already, but that's 12 months or less. Scott gave a great example of that. with those 3 to 4 month, maybe that one-off lease, you just need that specialized equipment for a short period. That's more of what the standard's getting at, as opposed to the month-to-month lease, where you really have to assess what the real term of that lease is, if it's automatically renewing, for instance, in some related party lease examples. Next item here is related to lease payments. So what's all included in the lease payments when you're measuring the lease? The first is related to fixed lease payments. So those are kind of the obvious piece that's included here. You could have in-substance fixed payments. So there could be an option within a contract. Hey, you pay for a piece of, or let's say a vehicle, you pay $100 fee plus 50 cents per mile after that, or you pay a flat fee of whatever it is, $250. Well, even though there's two options there, it's unavoidable in that first portion to pay that $100. So that $100 and the 50 cents, it's unavoidable to pay that $100. So that would be included in the lease payments as an in-substance fixed payment. Variable payments are still included if they're dependent on a rate or an index. So if you had an initial lease payment and it escalates by a market rate years, that base payment is included in the liability. Any payments that are truly variable, so they're based on usage or performance, those would be excluded. So if it's based on hours used on a piece of equipment or miles driven on a vehicle, it's truly variable, then those would not be included in the lease payments. There is a reassessment required in certain circumstances. This is mostly related to if you reassess the lease for another factor. So let's just say you exercise an option within the lease, something to that effect, so you reassess it for another factor, then you would have to go back and reassess the lease payments within the contract. Residual value guarantees, any amount that the lessee is probable to pay will be included within the lease. And then purchase and termination options. So if you're reasonably certain, going back to that word that we used before, if you're reasonably certain to exercise a purchase option within the lease, that amount of that purchase option will be included in the present value of the lease payment. So it'll show up as a liability on the balance sheet. And then also kind of in the termination options, if it's reasonable that you're going to terminate the lease before the end of the lease and there's a penalty related to that, that penalty will be included in this present value of the lease payments, and it'll show as a liability as of the commencement date. Scott touched on these a little bit, but lease components. So I guess there's different things within this. There could be multiple lease components, so multiple assets that you're leasing. I think the best example is you're leasing a building, and that building is attached to some land. Well, hopefully it's attached to some land. If you're renting that whole facility, that land you're inherently leasing as well. So that would have to be evaluated whether that land and that building would have different classification. But if they have a similar classification and that land is not a significant portion of the fair value, in the old 840 guidance, there's a 25% bright line rule. That bright line rule is gone. So if that land is a significant portion, it would have to be assessed separately from the building. But most of the time you can put them together if it wouldn't be significantly different result. The other thing to think about is the non-lease components. So a great example here, you're renting that office space and you have the payment that's for the actual office space. That's going to be included as a lease component. That's going to be in the liability, but those common area maintenance charges would be accounted for separately. And so those would just be a period cost and expensed as they're incurred, and they would not, the good news here is they would not be part of that lease liability unless for some reason you would elect to not separate those because maybe they're just built into the lease cost and there's no easy way to separate them. But then you would have to do that for all of your office space leases. So it's by class of asset that you'd have to make that election. So in the in the realm of common area maintenance, sometimes those costs can be significant. So you would want to separate those out and have those as a period cost instead of putting those on the balance sheet. And then there's also some things that are not considered a component of the lease. They're not even a non-lease component. The taxes and insurance, they don't transfer any good or service as part of that. So they're not in the realm of the lease standard, and those will be accounted for separately. And just to note at the bottom, there is judgment in these. First off, in the separation of the lease components, and then also the non-lease components and the lease components, and then allocation of payments. So if you, in Scott's example of the copier, so you had the copier lease, and that copier lease includes so many copies and toner and paper and those things, and it's not separately identified. If you were to separate those lease and non-lease components, being the printer, bring the toner and paper, you would have to have the standalone price for each of those to allocate between the two components within that agreement. So then you can value it correctly on your balance sheet. Moving on, we're going to talk a little bit about the LESSEE accounting. So focus on the LESSEE accounting side of this. Our examples are related to the right of use asset and the liability that's going to be on the balance sheet. I think a lot of people are aware that this lessee is going to recognize this lease liability and this right of use asset, no matter if it's an operating lease or a finance lease. It's going to be on your balance sheet somehow, and where it differs is on the income statement. We'll get to that in a second. First off, we have a polling question here. The more significant consideration for related party lease recognition, we should clarify this is under topic 842, the new lease standard. Substance over form or legally enforceable rights? All right, so it looks like legally enforceable won by a small margin there. Under topic 842, legally enforceable rights is the new standard. And so you really need to look at those contracts. What's legally enforceable within that contract? The substance over form, that's the old policy now. That's no longer applicable. So you got to really look at those legally enforceable rights. I think the area is these related party leases. That's really the biggest area where this consideration is going to come into play. So I briefly mentioned the lessee accounting as far as the financial statement impact, the actual face of the financial statements. Balance sheet, we know what that's going to be. You're going to have an asset and you're going to have a lease liability, and they're really valued the same, whether it's a finance lease or an operating lease. So you really start off in the same place. The differences are when you go to the other statements. So the income statement effect, the finance lease is really the same treatment as the capital lease under the old guidance. You're going to have the amortization of the right of use asset, and then you're going to have the interest expense on the lease liability that's going to be recorded. Two separate costs. They're both going to be in the income statement. And those two separate costs on the cash flow statement, just sticking with the finance lease here, the principal will be a financing activity. So the payments on that lease will go under financing, and then the interest expense will be an operating activity. So a couple different classifications on the finance side. Moving over to operating leases, income statement effect, the lease expense is on a straight line basis, and so it really should be very similar to the expense recognition under 840. So the new guidance and old guidance as far as the income statement goes should be very similar, and the same goes for the cash flow statement. Those operating lease payments are generally under the operating cash flows. Finally, we'll go into an example here. Once again, this is on the lessee side. And so we can read through the terms of this lease. 3-year lease, economic life of this equipment is 5 years. There's no purchase option. Payments $2,000 a year, interest rate 7%. And so we get down and we get a present value of the future payments of $52.49. And so if we went through all of these factors, we'll assume that there's no transfer of ownership at the end of the lease, and this is not a specialized piece of equipment. And not saying, like Scott mentioned, the bright line tests are gone, but they're always a good guide as far as determining whether the lease term is a major part. So here we have 3 or 5 years, so about 60%. So we're not going to meet that test. and then the present value is only about, well, it'd be about 52% or so. And so we're probably not a substantial part of the fair value either. So we'd have an operating lease under this example. So if we look at the operating lease here, at that commencement date of the lease, we put that right of use asset and that liability on the balance sheet for the 5249, and then we amortize the lease obligation just like a note payable amortization would go through. And then our expense recognition, you can tell on the lower right there, it's $2,000 every year. So it's that straight line. It's just equal to the payment in this example. And so that expense recognition is still on that straight line basis, and really any difference goes through the right of use asset. And so then in this example, since we started off in the same place, we'll actually amortize down the right of use asset and the lease obligation in the same manner. Let's say the facts changed a little bit and we actually had a finance lease. Let's say it was a specialized piece of equipment, so we had to put it as a finance lease. The initial recognition, the 5249, is the same for both the right of use asset and the lease obligation, but you can see the expense recognition is different. Now we have straight line amortization of that asset. So we have $1,750 every year for the amortization, and then we recognize the interest expense. And so our total expense that's within the income statement is not straight line. It's in the two different forms. So that's the difference between really the recognition of measurement under the operating and finance lease with a similar fact pattern. So another polling question to go through. Topic 842 provides a bright line test that a lease term that spans 75% of the useful life in an asset triggers treatment as a finance lease. True or false? So 60% said false on that. That is true. That 842 does not provide that bright line test anymore. It just says it's a major part. Maybe a little bit tricky is that within the kind of the footnotes of the standard, it does say that a reasonable basis would be a 75%, but it is not actually in the standard. So there's more subjectivity, there's more judgment that's involved with 842 when you're defining what that major part of the economic life is. So the right answer there was false. Going back to our example, these would actually be the journal entries. Kind of let everyone look at this. You can take this slide deck as a reference point here, but financing and operating lease, you start off at the same place in the recognition, and then where you differ is at the end of the year when you're recognizing that lease expense and that cash payment, and I guess the amortization on the financing side. That's where you're going to differ between in the subsequent measurement of the two different classifications for the lease. Some other factors to consider here: operating leases, kind of going on that. That's the most significant change that's going to change up the balance sheet. Really, the biggest impact is with the covenants. We got to think about what the covenants are that are out there. Impacts on current ratios. There's going to be a current portion of that lease liability to consider. Quick ratios. Really, it's the effect on the liabilities that are out there. If you have a debt to equity ratio, that's obviously going to be impacted with this. And so discussion with the bank is going to be a critical part of this to make sure that they understand what the impact on your financial statements is. And so you can make sure that all of your covenants are set up correctly. And so you're not violating covenants just by adopting a new accounting standard. Going to the next slide here, there's a few factors ratios that won't be impacted. Really anything on the income statement side. So EBITDA, gross margin, operating ratios, net worth really will not be impacted. Your equity portion, because the expense recognition is very similar, so that equity portion is going to remain fairly consistent between the two standards. The last thing I want to go through here is what do I need to do now? It's really thinking about this lease standard, understanding what the impact is going to be. So making a list of all the leases, performing a review of the contracts to determine if they're going to be accounted for differently, different classification. Like we just mentioned, review your debt covenants, making sure that those still make sense. Considering rule changes that will affect lease versus buy. There's some companies that might just lease an asset so they wouldn't have to put it on the balance sheet. But now that everything goes on the balance sheet, there could be some different decisions there or negotiations of the terms. Like we said, that term is a very important part of the lease standard. And so there could be different determinations there. And then the final thing is related party leases need to be clarified and or updated for their documentation. Like we said, it's that legally enforceable terms and conditions, and that's very important when we get into the lease, the related party leases, and making sure that those are accounted for correctly. So with that, that kind of closes up the GAAP accounting. We have one more polling question that's out there. Number 3, an organization could have an accounting policy to not record leases with terms of less than 12 months. True or false? Yeah, I did have one question that came in from David. We'll address that at the end related to different software products that are out there. An organization, so back to this polling question, you could elect a policy for leases less than 12 months, just making sure that that 12 months is the true term of the lease before you make that election. With that, I'll hand it over to Andrea Mao, and she'll take us through some of the tax considerations.
All right, thanks, Scott and Matt. I appreciate you guys letting me tag along here so we could talk a little bit about some of the tax implications of these new standards and what's going on in leasing in the tax space. So as a preliminary matter, I think there's a lot of confusion when tax accountants talk to GAAP accountants about, is this a lease or not a lease? In the GAAP world, as Matt and Scott have talked about, there's 2 different classifications of lease. The operating leases, where ownership remains with the lessor, the lessee merely has a right to use the asset, or a capital finance lease where ownership is transferred, but they're still they both carry the lease terminology. In the tax world, the only kind of lease that we have is a true lease. This is going to be consistent with an operating lease for financial accounting purposes, in that the lessee only receives the right of use of the asset. They do not have ownership of the underlying asset. In any transaction where the underlying ownership of the asset transfers, it is not considered a lease for tax purposes. You'll see those referred to perhaps as a financing or a conditional sale type transaction, but those are technically not leases. So even though the GAAP accountants may be referring to something as a lease, it may not be considered a lease for tax purposes. The tax criteria for distinguishing leases from other transactions, sales, or financing transactions are based on which party has the benefits and burdens of ownership of the underlying property. So when we're looking at that, we're typically looking at the underlying economic substance of the transaction. Has the economic rights, benefits, and risks transferred from the lessor to the lessee, or are they retained by the lessor? This is a facts and circumstances analysis. Consistent with the new GAAP rules, there aren't any bright line tests. One area where we may differ from the GAAP rules is that we will tend to look at all of the factors in a lease, and not one factor will be determinative. So for example, if the term of the lease exceeds the rule of thumb that Matt and Scott talked about, but the present value was less than the rule of thumb threshold for that, we look at those together. Just because we crush one of those thresholds does not necessarily dictate that that's how the lease transaction is going to be classified. We're going to need to look at the totality of the circumstances. And in some cases, the intent of the parties can be quite important. As you might imagine, this is being a facts and circumstances analysis, there's a lot of gray here, and it can be uncertain in many situations which party truly is considered the owner of the asset for tax purposes. So in some cases in lease agreements, we will see that the parties will stipulate the lessor will be considered the owner of the property, will claim all tax benefits related to the property, or the lessee will be considered the owner of the property and be entitled to those tax benefits. So it's important to look at those lease agreements, because sometimes that can tip the scales one way or the other as to whether it's a lease or a sale. These are some of the relevant factors that courts and the IRS have considered in distinguishing between leases and sale or financing transactions. As you can see, there's quite a list of them, and if you ever sat down to read all of these cases and rulings and PLRs and everything else, I would recommend taking several days off of work, because there is a lot of authority out there. Some of it's contradictory, some of it seems consistent, some general rules seem to come through, but not under all circumstances. So this is just to give you a flavor of the type of issues that need to be considered in distinguishing between leases and financing or sale transactions. Some rental provisions that we need to make sure we're watching for in lease agreements. So purchase and renewal options, much like Matt and Scott discussed, we're going to be looking at the likelihood of whether that's going to be exercised at the end of the lease. And that will be based on the economics. Is the lessee effectively economically compelled to exercise that option in order to get the economic benefit of the relationship? So for example, if they're going to pay $100,000 in lease payments over the term of a 5-year lease and have a $10 purchase option at the end, they're going to be economically compelled to make that purchase because of because effectively at that point they've already paid for the asset. So that extra $10 is going to be likely necessary in order for them to make a solid business transaction. Rent to own provisions, this is where a portion of the rental payment is treated as is creditable to the purchase price, and sometimes these are coupled with a purchase option at the end. And in this case, what we're looking at is are the rental payments above or below market value? If your rental payments are significantly above market value, odds are you're actually buying the property as you're going along. Whereas if your rent payments are relatively flat with market and your purchase option at the end is not guaranteed to be executed, maybe it is still a lease for tax purposes. And then track provisions, we see these in some equipment leases. They're effectively similar to the residual value guarantees that Scott and Matt talked about earlier. The parties agree at the outset, this property at the end of this lease will have a value equal to 20% of its current price, which we assume will be equal to fair market value. And as long as those values are set near fair market value, we can actually ignore these terms sometimes in our lease analysis, but it's important to notice whether they are included in the leases. And why does it matter? What are the stakes here between classifying something as a lease and classifying it as a financing or sale transaction? Well, if it's a lease, then your lessee and your lessor are going to have deductible rent expense for the lessee and rental income from the lessor, and the lessor will be retaining the depreciable interest. Your financing sale transactions, all of those payments that look like lease payments are actually going to be treated as a partial return of principal and partial deductible interest expense. And then on the lessor side, you have your interest income and principal collections. And in this case, the depreciable interest in the property transfers to the lessee at the outset of the lease agreement. And as we're going to see, that the main issue that comes up from a tax perspective is which party has the depreciable interest, because that's where we see the most material impact related to the differences in accounting here. And so this is just a sample fact pattern where we'll go through it in a lot of detail. Effectively, it's a 13-year lease with flat monthly payments from 2015 through 2028. And this is the tax consequences to Business A. Business A is our lessee in this situation. And the question becomes, okay, what does this actually do on a timing perspective? And so we'll actually start here at the bottom, and you'll see that the total lifetime income, regardless of whether this is classified as a lease or a financing, is the same. What is going to differ is when that income and expense is actually recognized on the tax return. So if we treat this as a lease, our lessor will have lease income for 3 years. This is our top part of this chart is through the end of 2018. So in that case, they've collected 3 years worth of lease income, but because they have the depreciable interest in the property, if this is equipment, it's likely eligible for bonus depreciation. And so we've taken the majority of the depreciation on these assets in the first 3 years of this lease. So actually through the end of 2018, we reported an overall net loss for tax purposes as a result of this transaction. However, when we get to towards the end of the lease, this is going to flip because our only deduction available is depreciation, and most of that is gone, but I'm going to have 10 years of lease payments coming in that I need to take into account. And so by classifying this as a lease, I have effectively accelerated my deductions and deferred my income, which is, as you'll see in the column to the right on the financing transaction, in that situation, we'll have a gain loss on the sale and then interest income. So they'll pick up $23,000 in income over the first 3 and then $30,000 over the back end. So it's a relatively flat income accrual if you are not entitled to the depreciation. So the key question that typically comes up is which party is entitled to the depreciation. And if we find out that we have misclassified something, so for example, it should have been treated as a lease and we treated it as a sale instead, there is an accounting method change we can file to reclassify that from a sale or lease to a financing or vice versa. However, this is a difficult change to actually file in some cases, because we don't get a Section 481A adjustment, meaning that we are not going to retroactively change any of the income or expense that we've recognized on these leases. So if I assumed I was entitled to the depreciation and I took it, I can't give that back. Similarly, if I decided I should have been entitled to the depreciation and I didn't take it, this will not allow me to do a catch-up adjustment. It also only applies to leases entered after the beginning of the year of change, so we cannot modify any previously executed leases, and we get no audit protection, meaning that the IRS can make a change to our return in order to take into account the differences in treatment of these assets. There is a non-automatic accounting method change option. We do not see a lot of clients go through this. The main thing here is it will allow us our catch-up adjustment or 481A adjustment. It'll allow us audit protection, but we have to get sign-off from the lease counterparty indicating that they intend to treat the transaction in the same manner as we are, which can be difficult to obtain in some situations. And so our final polling question, true or false, financial accounting and tax accounting always classify leases in the same manner? That is correct, yes. We will quite frequently see book tax differences on the lease treatment, which is unfortunate for the tax accountants that do not understand that there needs to be a difference. Sometimes following book in this scenario can get us to a very bad answer for our clients. And then to comment on the new GAAP leasing standard that Scott and Matt discussed, as of right now, there's no indication that the IRS intends to make any changes to the current lease analysis for tax purposes. And what that means is that whether a transaction should be classified as a lease or a sale is going to be based on the factors that we talked about. It's not going to be modified as a result of the new standards. And then primarily what we're going to see is a change in an impact on our deferred tax assets and liabilities, as the right of use asset and lease liability will generate some book tax differences on the amortization of those items. One other issue that comes up quite frequently in the tax space I wanted to mention briefly, 467 rental agreements are agreements where there's a significant amount of prepaid or deferred rent. In many cases, GAAP will straight line these leases, and the tax rules are different than GAAP. We sometimes are required to straight line, but many times not. The main goal of the tax accounting side of this is to take into account the time value of money component that's going on here. And for those of you who have been dealing with the new interest expense deduction limitations under 163J, the impact of this provision is that the components of these payments that are classified as interest need to be treated as interest for purposes of the 163J analysis. Finally, so just some quick takeaways. Make sure that we're reviewing the lease agreements for tax purposes. Don't just follow book. Because our requirements are different, we may not be coming to the same answer as book is, but it's also important to leverage what our financial and financial accountants and auditors are doing to understand why they're coming to the conclusion that they're coming to, because that may be reflective of the economics of the transaction, which we should be taking into account in our analysis. And I think we're out of time, but do we want to try answer the question that came in, or just answer offline?
Yeah, Andrea, I'll just take it real quick. David had asked a question about lease software and good tool for organizing and administering the new compliance responsibilities. And I'll just say briefly, there's software packages out there, anything from a souped up spreadsheet to a full lease management system. So there's everything in between. And so really the selection of a software package is based on the circumstances of the entity and how many leases they have, and I guess how much they want to pay for the software packages and what kind of management of the new standard they want. So it's really up to you and entity by entity consideration there.
And we did get one more question on the tax side that came in on the finance lease interest expense, whether that's also going to be subject to the interest expense limitations under 163J. And the answer there is yes. We will need to factor that interest income or expense into our 163J calculation, unfortunately. All right, well, this is our contact information. If you have any follow-up questions or comments, feel free to reach out to any of the three of us.
Awesome. Thank you all so much. And thank you to our presenters, and hope everyone has a great day.